Imagine a world where a single firm has the power to influence the homes we live in, the companies we work for, and even the governments we elect. This is not a dystopian novel. It's a reality unfolding with BlackRock, a financial powerhouse managing over $9 trillion in assets. That's more than the GDP of every country except the US and China. This immense control affects everyone, from young professionals to retirees, with trillions of dollars at stake. BlackRock's reach into housing markets and corporate boardrooms could redefine the concept of ownership in America, shifting wealth and power dynamics in unprecedented ways. This is not an isolated event. It is part of a recurring three-stage financial cycle leading toward concentrated economic power and diminishing individual ownership. BlackRock's increasing influence is a symptom of this larger cycle, where financial institutions amass unprecedented control, reshaping economic landscapes and impacting personal wealth across generations. BlackRock's financial scale is staggering. Managing over $9 trillion in assets, it dwarfs the GDP of most countries. This scale allows BlackRock to wield significant influence over global markets, including equities, bonds, and real estate. The scale is not just about numbers. It translates into real-world power. For example, BlackRock is a top shareholder in major corporations like Apple, Microsoft, and Amazon. This gives them a seat at the table in critical business decisions affecting everything from corporate policies to investment strategies. Geographically, BlackRock's influence stretches across continents. In Europe, it's deeply embedded in pension funds and government bonds, shaping fiscal policies and economic stability. In Asia, its investments in technology and infrastructure are pivotal in driving regional growth. In the US, BlackRock's presence in real estate has sparked debates about housing affordability and market accessibility. This geographic reach means BlackRock's decisions can have ripple effects on local economies, influencing everything from employment rates to consumer prices. Key actors in this scenario are not just BlackRock executives, but also governments and regulatory bodies. BlackRock's influence often positions it as a de facto advisor to central banks and financial regulators. For example, during the 2008 financial crisis, BlackRock was tasked with managing toxic assets for several governments. This intertwining of public and private interests raises questions about accountability and transparency. The firm's role in advising on monetary policy and fiscal strategies can sometimes blur the lines between public service and private gain, affecting policy outcomes that touch every citizen. Capital flows directed by BlackRock are massive, influencing global economies. The firm channels investments into specific sectors and regions, impacting economic growth patterns. For instance, BlackRock's focus on sustainable investments has accelerated the transition to green energy, shaping energy markets globally. However, this also means that BlackRock's priorities can sway capital away from traditional industries, which might struggle to compete. The balance of where capital is directed affects job creation, innovation, and even geopolitical stability. In 1988, BlackRock was founded by Larry Fink and a group of partners. Initially focused on risk management and fixed income investment, it quickly grew due to its innovative approach to financial analytics and risk assessment. By the 1990s, BlackRock had expanded its services, establishing itself as a trusted advisor in the financial sector. This foundation laid the groundwork for its future growth and influence, setting the stage for its pivotal role in subsequent financial events. In 2008, the financial crisis marked a turning point for BlackRock. The firm was called upon to manage toxic assets for the US government, solidifying its reputation as a critical player in the financial recovery process. This involvement not only expanded BlackRock's influence, but also positioned it as a pivotal advisor to governments worldwide. Its role during the crisis exemplified its ability to navigate complex financial landscapes and reinforced its status as a trusted entity in global finance. By 2010, BlackRock had acquired Barclays Global Investors, becoming the world's largest asset manager. This acquisition was a strategic move that expanded its reach into passive investment strategies, such as ETFs, which became a major growth driver. With this acquisition, BlackRock gained significant control over the investment landscape. influencing the flow of capital and the structure of financial markets. This milestone marked a shift in how investment strategies were implemented globally, with BlackRock at the forefront. In 2020, amidst the global pandemic, BlackRock's influence reached new heights. The firm played a crucial role in the Federal Reserve's corporate bond buying program, helping stabilize financial markets. This action underscored BlackRock's integral role in crisis management and its ability to influence monetary policy indirectly. The pandemic highlighted the firm's capacity to operate at the intersection of public policy and private finance, further entrenching its position as a key architect of modern financial systems.
In 2016, BlackRock's influence expanded significantly when it established the Aladdin platform. This system, a vast network of data and analytics, became a cornerstone for financial professionals worldwide. Aladdin provides risk management and portfolio management services, handling over $21 trillion in assets, nearly half of the global asset management industry. This technological leap allowed BlackRock to wield unparalleled control over financial data and decision-making processes. Financial institutions, from banks to insurance companies, adopted Aladdin to optimize their portfolios. However, this concentration of power raised concerns about market dependency on a single entity. By integrating its technology deeply into the financial framework, BlackRock effectively positioned itself as an indispensable player, influencing not only individual investment decisions but also systemic risk management across global markets. This move marked a pivotal shift from merely managing assets to shaping the very infrastructure of financial decision-making. In 2020, amid the global pandemic, BlackRock's influence reached a new zenith. The Federal Reserve enlisted BlackRock to manage its bond buying programs, a decision that underscored the firm's pivotal role in the financial ecosystem. BlackRock was tasked with purchasing corporate bonds and ETFs, effectively stabilizing markets during a period of unprecedented volatility. This action reinforced the firm's reputation as a trusted steward of financial stability. However, it also sparked debates about potential conflicts of interest, as BlackRock's own funds could benefit from these purchases. Critics argued that this concentrated power in one organization might compromise transparency and fairness in financial markets. By acting as an intermediary for the Federal Reserve, BlackRock's role transcended traditional asset management, cementing its status as a critical player in the financial and economic landscape. This milestone highlighted BlackRock's dual role as both a private financial entity and a quasi-public institution with significant influence over economic policy. Interest rates are a fundamental mechanism in the financial system, dictating the cost of borrowing and the return on savings. When BlackRock manages significant asset portfolios, its influence on interest rates becomes apparent. For example, its decisions regarding bond purchases can indirectly affect the supply and demand dynamics for credit, influencing interest rates. Lower interest rates generally encourage borrowing and investment, stimulating economic activity. However, they can also lead to asset bubbles if maintained too low for extended periods. BlackRock's role in managing large-scale bond portfolios allows it to impact these rates by altering market expectations. In 2020, BlackRock's involvement in the Federal Reserve's bond buying program demonstrated this influence, helping keep rates low during the pandemic to support economic recovery. The resulting environment made borrowing cheaper for businesses and individuals, but also raised concerns about long-term debt sustainability. Understanding how interest rate manipulation affects everyday financial decisions is crucial for personal financial planning. Inflation, the rate at which general price levels for goods and services rise, erodes purchasing power. BlackRock's asset management activities can indirectly influence inflation, particularly through its involvement in bond markets. When BlackRock participates in large-scale bond purchasing, it impacts the money supply and consequently inflation rates. For instance, during periods of extensive bond buying, the influx of capital can lead to increased spending, potentially driving up prices. BlackRock's strategies can thus play a role in either exacerbating or mitigating inflationary pressures. A real-world example is the post-2020 pandemic era, where massive liquidity injections into the economy, partly facilitated by BlackRock's actions, contributed to inflation concerns. Understanding inflation's impact is vital for consumers, as it affects everything from grocery bills to mortgage rates. Monitoring inflation trends and adjusting personal budgets can help individuals maintain their purchasing power and make informed financial decisions. Capital flows refer to the movement of money for investment, trade, or business production. BlackRock's global reach means it can significantly influence these flows, impacting economies worldwide. By managing trillions in assets, BlackRock's decisions on where to allocate funds can shift capital from one region to another, affecting exchange rates and local economies. For example, if BlackRock increases its investments in emerging markets, it can lead to currency appreciation in those regions, making exports more expensive but potentially boosting local economies through increased capital availability. Conversely, withdrawing investments could lead to currency depreciation and economic challenges. The magnitude of BlackRock's capital allocations underscores its ability to affect global financial stability. Understanding these flows is crucial for governments and businesses as they navigate the complexities of international finance. For individuals, recognizing how these movements can influence currency values can aid in making better-informed decisions about travel, investment, and savings.
Cross-market links refer to the interconnectedness of global financial markets, where actions in one market can significantly impact others. BlackRock, through its vast holdings and investments, is a prime example of such interconnections. When BlackRock makes a large move in equities, bonds, or commodities, the ripple effects can be felt across various markets due to the firm's extensive reach. For instance, rebalancing portfolios can lead to significant shifts in asset prices, affecting global indices and investor sentiment. This interconnectedness means that BlackRock's strategies can have broad implications, influencing sectors from technology to energy. A real-world example is the 2020 pandemic response, where financial adjustments by BlackRock affected market volatility and recovery paths worldwide. Understanding these links helps investors and policymakers anticipate potential market reactions and adjust strategies accordingly. For individuals, recognizing how these connections can affect retirement accounts and investment portfolios is essential for financial planning and risk management.
To recap, we've explored how BlackRock's strategic decisions shape the financial landscape. First, we discussed the foundational role of interest rates and how BlackRock's actions can influence borrowing costs and economic activity. Next, inflation was examined, highlighting how BlackRock's asset management indirectly affects price levels and consumer purchasing power. We then delved into capital flows, demonstrating BlackRock's capacity to shift global economic dynamics through its investment choices. Finally, we looked at cross-market links, illustrating the interconnectedness of financial markets and BlackRock's broad-reaching impact. Together, these mechanisms highlight BlackRock's influential role in global finance and underscore the importance of understanding these dynamics for personal financial stability. In the next section, we'll delve into historical patterns to better understand how these mechanisms have played out in the past and what they might signal for the future. Next, we'll compare current events with historical precedents to unearth patterns that can provide insight into BlackRock's potential future impact. By examining similar periods of financial influence, we can identify commonalities and divergences that offer a clearer view of what might lie ahead. These comparisons not only enhance our understanding of BlackRock's strategies, but also equip us with the foresight needed to navigate the complexities of today's financial environment. Stay tuned as we delve into these historical patterns, drawing lessons and parallels that could illuminate the path forward. This exploration will help demystify BlackRock's role and offer valuable perspectives on managing your financial future in an interconnected world. To understand BlackRock's current influence, let's draw parallels with the 1980s, a period marked by significant financial innovation and deregulation. During this era, the rise of large financial institutions and the deregulation of banking practices reshaped the economic landscape. The introduction of new financial instruments like derivatives expanded market opportunities but also increased systemic risk. Similarly, BlackRock's technological advances and strategic maneuvers echo this period's innovative spirit. However, unlike the 1980s, today we face a more interconnected global economy. amplifying the potential impact of BlackRock's actions. The key takeaway from this comparison is the importance of vigilance in monitoring how financial innovations and deregulation can lead to both growth and instability. This historical context helps us appreciate the delicate balance BlackRock must maintain to foster economic progress without exacerbating systemic vulnerabilities. Let's now look at the 2008 financial crisis, a pivotal moment that reshaped regulatory landscapes and financial practices worldwide. The crisis, triggered by excessive risk-taking and lack of oversight, led to severe economic downturns. In response, financial institutions, including BlackRock, adapted by enhancing risk management frameworks and increasing transparency. Today's environment, however, presents unique challenges with digital advancements and unprecedented capital mobility. BlackRock's comprehensive risk management systems reflect lessons learned from 2008, aiming to prevent similar systemic failures. Yet, the increased complexity of global markets means vigilance is more crucial than ever. The main lesson from this comparison is the critical need for balance between innovation and regulation, ensuring stability while fostering growth. Understanding these patterns provides valuable insights into BlackRock's current strategies and helps anticipate how they might navigate future financial landscapes. In the best-case scenario, BlackRock's significant influence in the market leads to increased stability and efficiency. With its vast resources and data-driven strategies, BlackRock could help streamline financial operations, reducing redundancies and cutting costs. This efficiency could potentially lead to lower fees for investors and improved returns on investments. Additionally, BlackRock's focus on ESG, environmental, social, and governance criteria, might push more companies to adopt sustainable and responsible practices, benefiting society as a whole. In this scenario, inflation remains controlled, interest rates are stable, and the US dollar maintains its strength. The cost of living sees gradual improvements due to better managed resources and investments in infrastructure. Capital flows remain robust, attracting foreign investments and boosting the economy. This scenario assumes that BlackRock utilizes its power responsibly and regulatory bodies effectively oversee its operations to avoid conflicts of interest. In the base scenario, BlackRock continues to grow its influence in the financial sector but faces increased scrutiny from regulators. This leads to a more balanced approach where BlackRock's power is checked by regulatory frameworks that aim to prevent monopolistic practices. Inflation remains moderately high, prompting central banks to adjust interest rates cautiously. The US dollar experiences fluctuations, but overall remains a strong currency. The cost of living continues to rise gradually, but not at an alarming rate. Capital flows are stable, with some investors cautious yet optimistic about long-term prospects. This scenario assumes that while BlackRock's dominance persists, it is tempered by effective regulatory measures ensuring competitive practices in the market. The general economic environment remains cautious but stable, with gradual improvements in consumer confidence and investment. In the worst-case scenario, BlackRock's dominance leads to significant market distortion. The firm's large-scale holdings and influence could crowd out smaller investors and competitors, leading to reduced market competition. Inflation spirals out of control as unchecked power results in inefficient capital allocations. Interest rates skyrocket as the central banks struggle to contain inflation, leading to an economic downturn. The US dollar weakens due to lack of confidence in the financial system, causing the cost of living to rise sharply. Capital flows diminish as investors seek safer havens outside of the US economy. This scenario assumes that BlackRock's influence becomes too overwhelming and regulatory bodies fail to impose effective checks and balances. The result is a volatile economic environment with decreased consumer confidence and increased financial hardship for households.
One common counterargument is that BlackRock's size and influence are overstated, and its operations are largely beneficial. Proponents argue that BlackRock provides significant liquidity to markets, enhancing stability and offering investors a wide range of diversified funds. They suggest that BlackRock's data-driven strategies lead to more informed investment decisions, benefiting the broader economy. Additionally, some believe that BlackRock's focus on ESG criteria pushes companies towards sustainable practices, which is crucial for long-term economic health. These supporters claim that regulatory oversight is adequate and that BlackRock operates within the confines of the law, ensuring fair competition. They argue that rather than ending American ownership, BlackRock's approach democratizes investment opportunities by making sophisticated financial products accessible to retail investors.
Another counterargument is the view that BlackRock's influence is a natural evolution of financial markets, driven by technological advancements and globalization. Advocates of this perspective argue that as markets become more interconnected, large asset managers like BlackRock are necessary to handle the complexity and volume of global investments. They suggest that BlackRock's role as a major player helps mitigate risks and provide consistency in investment practices worldwide. Furthermore, they argue that BlackRock's scale allows for significant investments in technology and research, which can lead to innovations benefiting the entire financial system. Critics of the conspiracy theory say that BlackRock doesn't end American ownership, but rather reflects the changing nature of ownership in a globalized economy, where borders are less significant in capital allocation. To navigate the implications of BlackRock's influence, consider these 3 practical actions. First, diversify your investment portfolio to mitigate risks associated with large asset managers' market influence. Consider including a mix of asset classes and sectors to balance potential volatility. Second, stay informed about regulatory changes and market trends. Use trustworthy sources like the Federal Reserve Economic Data, FRED, to understand how macroeconomic shifts might affect your finances. Third, prioritize building a financial buffer. In uncertain times, having savings that cover at least 3 to 6 months of expenses can provide a safety net against economic fluctuations. These steps can help individuals maintain financial stability and resilience in a market where major players like BlackRock have significant sway.
Returning to our opening hook, BlackRock's influence on market dynamics is undeniable, yet it reflects a broader trend of consolidation in the financial sector. The core lesson here is the importance of understanding how macroeconomic forces interplay with personal finance. As we've explored, whether through potential stability or increased risks, the presence of a dominant player like BlackRock underscores the need for informed financial decisions. Takeaways include staying vigilant about market trends, diversifying investments to mitigate concentrated risks, and building financial buffers to weather economic uncertainties. By taking these actions, you can better navigate the complexities of today's financial landscape and maintain control over your financial future. If you found this perspective valuable, consider subscribing. Let me know your thoughts in the comments. I read every one of them. Thank you for watching.